Hi everyone, this is Frank with Teaching University. In this lecture today, we're going to be diving into Nicolas Darvas' book, How I Made $2 Million in the Stock Market. I think the book is a fascinating case study on someone who really didn't have much experience investing in the stock market, but was able to make a substantial profit of well over $2 million in a time when certainly $2 million was worth certainly a lot more than it is today, considering inflation. He made his millions in the 1950s, in the 1960s. So 2 million was certainly worth a lot more back then. So just to really kind of wrap your head around that in terms of how much money he was able to profit in the stock market. And I think what's great about the book is that there's a lot of hidden gems that we can take, that we can apply, not just when it comes to investing, but how we can handle different situations in reaching our goals in everyday life. And I think all of us yearn to be able to obtain riches in the stock market and in investing. Of course, all of us would like to earn more money. I think it's safe to assume we all like to be able to retire, be able to live a life of freedom and do the things that we want to do. And of course, it requires money to do that. And there's something emotionally powerful and euphoric about being able to earn as much money as possible with as little effort as possible, or without as much energy or stress. And I think there's certainly nothing wrong with trying to apply this approach. We want to be efficient with our time and maximize our results and minimize our energy and downside. But the problem is this mentality can be a double-edged sword, because this can lead to really gambling like behavior, where because we want to get rich quickly and try to amass riches, and this is where we can get very reckless and stupid and make poor decisions, and ultimately we end up going broke. And that's something that we want to avoid. We want to be smart by developing a system that can help us maximize our results and minimize our downside. And this is something that I think Nicolas Darvas was able to do in earning his riches. So to quote Nicolas from the book, he said, "There are no good or bad stocks. There are only rising and falling stocks." And I think this little snippet from the book is very revealing about his strategy. His strategy was the total opposite of, say, value investing, something that Warren Buffett and other value investors subscribe to. And their strategy is that they focus more on investing in great companies at a fair price or discounted price. Whereas Nicolas Darvas didn't really care so much about the fundamentals of the stock, or what the PE ratio was, or return on investment capital, or how much profit they were making per se. He didn't focus so much on that. What he ultimately focused on was how the stock was trading, and really the momentum of the stock and its price. If it was trending at 52-week highs, if it was rising, going up in price, then he would take advantage of the rising price and purchase shares of stock. Then, of course, if the stock was falling, then, of course, he would exit the position. And this just generic stock chart can kind of give us an idea of really what his whole methodology was that he took advantage of rising prices. He relied on momentum and the stock price itself. He wasn't so much concerned with the underlying fundamentals. And there's a lot of different strategies when it comes to investing and trading and earning our money. And I use the terms investing and trading interchangeably, though ultimately I think there is a difference between the two. Trading, I would argue, is much more of a short-term strategy. Investing is more long-term, to use those two definitions to describe investing and trading. So ultimately, I would argue that Nicolas was more of a short-term trader, where he took advantage of price movements. He entered positions where stocks were going up in price, and exited those positions when the stock was declining in price as well. And I think growth investors can probably also subscribe to that sort of strategy as well. So to quote Nicolas again, he said, "The word value cannot be used in relation to stocks. The value of a stock is its quoted price. This in turn is entirely dependent on supply and demand." So again, this kind of reinforces what I've been saying about Nicolas and his strategy, was that he relied on the market forces of supply and demand, and ultimately relied on price as the ultimate determinant of whether or not he entered or exited a position. So to use this stock chart here, this is from Apple. And again, this is not a stock recommendation. This is just for educational purposes for using this stock chart here. And this chart was taken of Apple in the earlier part of 2022. But we can see in these red and green bars below the stock here, the stock bars here, the bar charts, where we could see the red signaling the bears, where there's significant selling of the stock, and then the green bars, which indicate substantial buying of the stock in that particular day. So what Nicholas did was that he took advantage of supply and demand, where there was upward pressure on the stock, where there was more buyers and sellers in purchasing the shares of stock. When we see upward momentum, for example, we can go right around here. I would probably argue that it's around this position here is where Nicholas probably would have entered the position in Apple, where you would see that the stock will be trading at 52-week highs. We see significant trading volume where there's more bulls than bears, and we would see that he would enter probably this position here. I would provide an educated guess. And again, this is just a generic example, but it's also to provide really a glimpse of his strategy that ultimately he relied on momentum. He relied on the momentum of the stock through supply and demand, and using those forces as a signal, looking for signals as to whether or not he should enter a position. And again, this is as I said before, a far cry from someone like Warren Buffett, who, again, I'm also a big advocate of, who really divorced himself from the stock market. He's actually argued this, where when it comes to investing in the stock market, you want to forget about the stock market. He focused on investing in wonderful businesses that had a durable competitive advantage, that offered great products and services, and that had substantial value that he can invest in and at a discounted price. So it's a far cry from what Nicholas did. But it comes to show that there are a number of different strategies when it comes to investing in the stock market. It's ultimately trying to find one that works for you. I'm more of an advocate of value investing, but I think certainly momentum trading and investing has its place as well. So I think ultimately, however, how we can sum this up in what Nicholas did, and I think even what Warren Buffett and other investors, successful investors, do as well, is that they take advantage of asymmetric opportunity. And that can be defined as an opportunity where it's a simple one, where the upside is much greater than the downside. So what that means is that you're putting yourself in a position where you can maximize your returns or maximize your upside while minimizing the risk. And that is the most ideal situation almost any investor wants to put themselves in. You can take any investment course in college, and the professor will tell you that, where the optimal investment portfolio or strategy is to maximize your returns and minimize risk. And another way to put this, and maybe we can venture outside of stock investing or invest in the stocks for a moment, is where you're making bets and you're putting yourself in positions where when you make a bet or you take action or you make a decision, that you are putting yourself or positioning yourself where you maximize your upside and minimize the downside risk. Where, for example, we're rolling a dice or rolling a flip of a coin. If it's heads, you win. If it's tails, you lose, but only by a little bit. So it's constantly making bets and putting yourself where even if you lose, you can stay in the game. And that's ultimately the goal for all of us, is that we want to stay in the game. If we lose all of our money or we put ourselves in a situation where we can't take any more action and we can't stay in the game, then that's when really we ultimately lose and we can't achieve the kind of results and success we want, whether it's investing or any other aspect of our lives. And we can apply this outside of investing, for example, even like, let's say, in social relationships, where ultimately, if you want to, if you're single and you're dating, if you want to increase the probability of finding a significant other, entering a relationship, then you want to make more bets in that you want to interact with more individuals, where the more interaction you have, the more conversations you have, more dates that you go on, or the more people you ask out on dates, that it puts yourself in a position where it increases the chance of success, where the downside risk is that the person says no, but the upside can be massive, where the person could say yes, they want to go on a date with you, and so on and so forth, and then it goes on from there. So it's ultimately putting yourself in a position where you can win again, and again. And that's what ultimately Nicolas Darvas did, was that he put himself in a position where he entered positions that he was able to succeed and achieve massive upside, and he got out of positions where he saw that his position was weakening in the stock as the price started to fall, and he got out and exited his position, and he minimized his downside. And that's ultimately how he succeeded and how he won. And how we can apply that into our own lives is that we want to make more bets, whether it's investing or in relationships or in starting a business or any other circumstance in our lives. We want to be able to make more bets and make more decisions where we can win and minimize our downside as well. So I hope you enjoyed this video. Make sure to hit that subscribe button. We can watch all my lectures on personal growth, entrepreneurship, creativity, and wealth building. So thanks so much, and I'll see you next time.